Hey, it's Tom here, and welcome back to another episode of the Investing with Tom podcast. In this episode, we have a returning guest in a pretty well known finance YouTuber, Hamish Hodder. Hamish runs a YouTube channel with a little over 100,000 subscribers, and he hasn't been on the podcast for about a year and a half, pre even video versions of the podcast. So it was great to get Hamish back. We talked through a few different topics, some investing related and some kind of adjacent to investing, I suppose. We talk through basically Hamish's investment strategy, how he thinks sort of very opportunistically and has had long periods of time where he's made no investments at all, kind of balancing that against the fact that he has a YouTube channel where he's uploading content very regularly. So it was sort of interesting to talk through that kind of dynamic with Hamish. One of the investments or companies that Hamish does follow very closely is Netflix. So we got into quite a bit of detail, specifically on Netflix, but also on streaming as a business more generally. So I think that'll be a really interesting discussion for you guys to see and hear. And we wrapped it up with a few audience questions from both Twitter and YouTube as well. So if you enjoyed this video, be sure to subscribe to the channel. I think you'll really like this episode. Without further ado, let's roll this one with Hamish Hodder. Hamish Hodder returns to the podcast. Hamish, any guesses how long it's been since he came on for episode 1?
Oh God, I don't know. I think it probably was. I feel like it was near the start of a year, but I don't know which year it was. It kind of been. Was it last year or the year
They
before?
all blending together. It was
I
August
don't.
2021. It actually predated video, or at least the video, not predated video, predated the video version of the podcast. So
So was that the last time I was on?
that's the
Right.
last time you were on, if we don't count the Matt Peterson episode where you sort of co-hosted
Yes.
that one with me. So
Yeah.
it's good. It's good to get you back on.
Oh, thanks for having me. Yeah, it's kind of crazy. I feel like the last couple of years, there's a lot that's happened in like the YouTube space and in the investing finance world, but it also feels like it's gone really, really quickly. It's kind of crazy to think that we're in 2023, and yeah, it was what, like 3 full years ago that the pandemic began. That's just it's kind of crazy. I say this to everyone. It's like every year, and everybody says this, but it's like every year just feels so much shorter than the year before. And the last couple of years, I mean, even if through the perspective of how long we've been doing content creation, I think I started 6 years ago now, which is just crazy to think. How quickly the time has gone. But yeah, it's been good. Sorry about the my background. You're basically looking at, everyone gets a bit of an inside look into the back of my set because that's my camera over there. And then you're sorry for people listening on audio. This is a bit of a demonstration.
Go to the
It's my
YouTube version.
light, and then these are some sound blankets that I got, which are super expensive but so good at killing the echo in this room. So there you go. You get a bit of a back look at my studio.
I like it. I like it. This is why people come to the podcast. They get the inside scoop. Much longer,
Exactly.
slower format than a speedy YouTube video. Yeah, it seems like the last few years have kind of all just sort of meshed together, I reckon. And you're
Yeah.
right; they always seem to go faster. It reminds me of, I think it was a Buffett joke actually, when he talks about like everyone always asks him about his age and how much longer he's going to be at Berkshire, and he sort of argues that he's only getting a little more than 1% older each year. It's really the younger managers you need to be concerned about.
Yeah.
So that's maybe one way to look at it.
Yeah.
Let's kick this one off in terms of still kind of focusing on the past couple of years, actually, just in terms of some of the things that have gone on in the market, which have been, I don't know, it's been a volatile few years. I guess that long may it continue, really, from our perspective, I would say. But
Yeah.
how has the past couple of years been for you, I guess, investing wise, first of all?
Yeah, it's certainly been interesting because, I mean, I only started investing in 2017. So it's not as if I experienced a huge period of low interest rates like people who have been investing for a couple of decades, for example, have just had this enormous period, or this paradigm, as Ray Dalio will call it, of low interest rates, and then such a dramatic shift that we've seen over the last couple of years. But I certainly had a number of years in that low interest rate environment, and then yeah, just in the last couple of years, it's gone from basically. I remember in 2018, 2019, especially making content, I was just thinking there really isn't anything happening in finance. There really wasn't for like at least those couple of years. And then in the last couple of years, it's been enormous. And from my perspective, yeah, as you said, it's been really volatile, and volatility really creates a lot of opportunity in investing, especially if you're a value investor. You really uh, not that you like markets where there's a lot of trouble going on, but that's where the opportunities are, where people are unsure how things are going to look in the future, and that causes mispricings. And I was listening to a Steve Easman interview, who's one of the characters out of The Big Short. He did an interview on CNBC, and he basically summed up what's happened over the last couple of years really well, in that up until 2020, especially the last kind of that decade from 2010 to 2020, you really got paid to take additional risk. So the stocks that did extremely well were, the best performing group was essentially these high growth tech companies, and even higher performing than that were these high growth, unprofitable, negative earnings companies. And that has really shifted in the last couple of years with the shift towards a higher interest rate environment, where last year that exact group that has done so well for a decade was by far the worst performer. And that kind of reflects a shift in where people are investing their money. And you're no longer really getting paid to go deep out on the risk curve. And that's a good environment if you're a value investor, because I don't like taking abnormal risk. I'm probably one of the most conservative, although maybe people would disagree with that, but in terms of the way that I think about investing is always from a place of capital preservation first, and only investing where I'm extremely confident. And in that world, a higher interest rate environment, as tough as it is to transition from a low one, it's a better place to be for investors, I think, generally.
Yeah, I tend to agree. How do you sort of manage through that period? Because, like you say, I mean, in the grand scheme, neither of us have been investing a particularly long time. Um, but it also seems like, you, for example, would never really got remotely close to like the high flying tech
No.
unprofitable type companies. Where'd that sort of where'd that kind of thinking come from to maybe stick to the more conservative type businesses?
Where'd the thinking come from? I mean, I've always just been drawn to. I mean, it really just comes back to fundamental value investing. I mean, I like listening to a lot of particularly modern Warren Buffett stuff, and I say modern Buffett stuff, but it's really Buffett of the last 4 or 5 decades. So it's it's
Yeah,
it's modern Buffett, but modern as in the last half century of his life,
yeah.
rather than the first half century.
Since he got his first grey hair, maybe, and that's kind of going back a while at this point.
Yeah, so I mean, that's always a place that I felt comfortable investing, and I've never had any issue being extremely patient. And I think in the last couple of years, and maybe this is why it was so difficult to be a value investor of the past decade, because uh, you in the last 5 or so years where I've been investing, a lot of that 5 years was spent being patient and just waiting. And I can imagine how it would have been very difficult being a value investor. Uh, Having to be patient for a much longer period than just the last couple of years. It was kind of fortunate in a way that um, the markets have kind of shifted back to a more normal environment, relatively quickly. Um, so that's where it's kind of been for me, and I've really had no issue just waiting. I think I made, there's been a couple of years in the past 5 or 6 years where I've made no investments, and that's never something I've had an issue with. Uh, and I think with the environment we're in now, I think I think it would be likely that I'll find more opportunities than I did. Like 2019, for example, was one year, or 2021. Um, but we'll see. I've made about one large investment on average per year, and that's yeah. I'm not really. It's a strange way to invest, because I'm very out of like the noise of the market. Even though I like covering that stuff, I think it's interesting. The way that I invest, my portfolio really hasn't changed at all for a very long time. So there's been new additions, but I've got large investments that I've held for since like 2018. So, it's just kind of, I guess, a process of ignoring the short-term noise and just looking at the businesses. And um, the environment we see at the moment with rising interest rates, it's hurting a lot of businesses in the short term, but it's not really going to impact the companies with durable advantages. And that's why it's not really, something that I've had trouble dealing with.
Yeah, for sure. And it's nice when we get those sorts of ideas of like maybe larger but certainly less frequent bets enforced in, like, Buffett's latest letter, for example. He sort of talked through, right,
Yeah.
only having a handful of decisions or so in the past several decades that really moved the needle for Berkshire. Is that kind of how you think about it with your personal portfolio?
Yeah, yeah, 100%. And of course, you're not going to be. Not every decision that you make is going to be correct. It's not about, yeah. I think he said, he's made 12 good investment decisions. About one every 5 years has been, a
That's right.
meaningful impact. And that's not to say that you would just try and find one good investment over 5 years. You're going to find more than that, and then filter through, which ones you're actually correct on. But that philosophy has always made sense to me, that thinking about it as if you are a very large owner in the company, and that you intend on being a part of that business's future for many decades. And if you do that, of course, that eliminates the vast majority of companies, because only very few will survive for multiple decades. I mean, the vast majority won't even last that long, or will be
Yeah.
acquired for far less, or die. So that's kind of the nature of it. But yeah, those are the businesses I'm very much attracted to, and they have, different businesses in different industries will have different characteristics. Uh, the investing world is just so vast. I think it's a process of having a few pockets where, whether it's an industry or a business model that and understand really, really well, and just sticking in those areas, uh, then you'll do well. If as long as you don't stray outside of those areas too much, yeah, I think you'll do reasonably well.
Yeah, I like it a lot. We were talking a little bit before we hit record here about, I think a couple of years ago, or maybe a little less than that, you were sort of toying with the idea of potentially buying real estate, and then kind of reversed that decision, I guess, and chose to focus more on just investing in businesses. Can you kind of talk us through what what thought processes you were going through there? Because I feel
Mm.
like a lot of people around our age, it's almost like a social sign of success to like buy a house in your 20s or something. It's like the thing
Yeah,
every Australian and New Zealander kind of
yeah.
wants to chase for whatever reason. So yeah, how do you think through some of
Well,
those things?
well, I think real estate for a lot of, especially in good areas. Obviously, this doesn't apply everywhere, but in Australia, in capital cities, uh, real estate will likely be a very viable investment. There's going to be consistently increasing demand for properties there. Uh, and so it's going to be a reasonable place to invest, and with the use of a bit of leverage as well. The growth of the rental yield does or the rental income doesn't have to be absurdly high. They don't have to grow their earnings. The property doesn't need to grow its earnings at 15% per year. It can grow at a very small amount, and then you're basically using leverage to expand your return. My thought process when I started really thinking about buying a property was probably in the middle of 2021. And it was just because I'd made a number of investments in 2020 that had done very, very well, but the market very quickly uh, went back to a place where I guess what I'm saying is I thought, in 2019, the market was very expensive in my view, and I couldn't find any opportunities. And then in 2020, things changed very quickly, and there was a lot of opportunities. And I, in a way, was kind of hoping that conditions wouldn't improve so quickly in the way that they did. We really did kind of get this V-shaped recovery where the market just went straight back up.
To the moon.
Um, and yeah, I got some investments in, but in 2021, it was back at a place where I really couldn't find anything. I didn't make any significant investments in 2021. I made a couple of small ones right towards the end, which I ended up rolling back anyway. But I really didn't make any investments. So it was in that kind of lack of opportunity that I considered looking for at some real estate. And then that, in 2022, it shifted again, and things started to get cheap, and the market itself didn't go down an enormous amount, not as much as 2020, but there was individual opportunities, or I should say one individual opportunity that swung very quickly. And so I just put the money there. And I think I do want to get into real estate. I think it's a good place to be, and to have a diversified portfolio between different assets makes sense. But at the end of the day, if there's a business opportunity, or an opportunity to invest in a business that I understand really well, then that's where I feel most confident. So that's where I'm going to put my money. So that's kind of the situation. But who knows? I mean, maybe, if I can't find any other opportunities over the next couple of years in the market, then maybe I'll return to the idea of real estate. But we'll see. It's the Australian housing market it's not in great condition at the moment. I mean, I think long term, as long as you can make your payments, you'll be okay. But certainly, it looks like there'll be quite a bit of pain in the short term. Not that that's factoring into my decision or anything, but yeah, that's how it looks. And if that creates a really absurdly good opportunity in real estate, I will take it. But we'll see. Yeah.
Yeah, that's what I was about to say. It's sort of looking like it could be carnage sometime soon with both New
Well,
Zealand and Australian real estate.
yeah. I mean, the Australian situation, for those who aren't aware, is there's a lot of short term fixed rate interest. Well, like they're fixed rate interest rates, but they're only fixed for 2 years, and the rate is essentially going from, I think it was about 2.2% in 2021, and that's going to roll over into about 6.5 to 7% now. And that's in Australia, it's 800,000 mortgages that'll experience that this year, which is about 13% of all mortgages in Australia. So it's an enormous amount of sudden. It's kind of like a cliff in a way, where a lot of people are going to see a 2 to 3 times increase in the interest on their payments. Their overall payments won't go that much unless they're interest only loans. But nevertheless, there'll be a very large increase for a lot of people in a time where there has been a lot of inflation, and people are already feeling the rising cost of living. So, I'm not an economist. I don't make short-term predictions, but it definitely looks concerning. And yeah, as I said, that doesn't factor in. I'm not avoiding real estate because it looks bad in the short term, or I'm going to buy it because I think it looks good in the short term. It's just something that's happening. And if it presents an opportunity, then I will take it, in the same way that I have no idea what the stock market's going to do. But if it so happens that there is a recession this year, or some other event that causes the market to go down, then, and there's an opportunity, I will take it. But otherwise I won't.
Yeah.
I feel like my approach is just it's very laid back. I mean, it's not laid back in the research, but it's like I'm I guess I'm just very patient, and I just have no emotional feeling about stocks going up and down. As long as I understand what I own, uh, I just I for some reason I just don't feel any emotion. So yeah.
Stone Cold Killer, Hamish Otter.
Well, I feel emotionally. Now, I'm not I'm not heartless. I have feelings. It's just when it comes to money. If I am confident in what I'm looking at, then for some reason I just don't have any I don't know. I just don't have any negative feeling about a stock going down. I will very happily watch a stock that I own drop 50% if I know it's worth a lot more than that. It's a very specific type of emotionless. I don't know.
Yeah, well, I think it comes from a place of, like you say, knowing what you own. Like if you
Yeah.
were in an index, for example, or you bought some random stock that, I don't know, someone tweeted about or something, and it went down, and you really didn't know what you own, it might be a different story.
Yeah, and
Sorry,
sorry,
go ahead.
all I was going to say is, yeah, and I've certainly experienced that. There was a clothing company that I bought in late 2021, ASOS, um, and there was a business that I didn't invest that much into it. It was just a couple of percent in the portfolio, but it was one that I definitely rushed into in hindsight. It was definitely a mistake. And you're right. Certainly with that investment, as it dropped, I did feel I did feel as though I might have made a mistake. And that kind of helped me to realize, okay, I need to really look at this company and can I make it reach a conclusion on it. Um, so yeah, you're right. It really is about whether you know what you own, um, for sure.
Yeah. The Hamish Hodder management curse also didn't help with ASOS, right? Talk us through what happened there.
Yeah, I mean, yeah, my
And your track record. Talk us through that.
yeah, I've got some like whatever I'm doing when I analyze companies, I find the companies where the CEO is just about to leave. It's kind of crazy. Almost every investment that I've made, the CEO has either left the company, gone to become the chairman, or has passed away. And it's been, I think, 5 out of 6 major investments that I've made where that's been the case. The only one where it hasn't been the case was Meta, which I don't own anymore, but that's the only one. And uh, yeah, so that's really the only one. But yeah, ASOS, the CEO who I really liked and was actually a big part of the story, or my thesis for ASOS. He left 2 days after I made that investment, and the stock collapsed immediately after it. So that was just really great timing. And then, yeah, since then, Reed Hastings, the founder of Netflix,
Of
stepped
course,
back
yeah.
from the
Forgot about that
CEO
one.
role. So it's yeah, I'm still on a great strike rate with these guys.
Yeah, at least you did have a co-CEO already in place in Netflix, though, right? Like it
Yes,
wasn't a
yeah,
complete
no.
top job change.
No, no, and he's still executive chairman, so he still is technically on the management team. Although, of course, he's going to be stepping back from his day to day. But and I do really like the rest of the management team. So it is a bit of a different story to ASOS, where yeah, I mean, I really hadn't done as much work as I should have on that investment, and when the CEO left, I kind of looked at what was left and I was like, oh, this isn't exactly what I thought I was buying,
Yeah,
which speaks to why um, I like to just do a little investment first, because I think I always do a significant, or I try to do a significant amount of research before I invest, but it usually is after I make a little investment that I feel more that I have skin in the game, or to some extent, where then I really commit to going deep on the company. Something kind of mental just kind of clicks when you own, or at least for me, when I own a little bit of the company. So that was where ASOS was for me. It wasn't a huge loss. I think the stock, when I sold it a few months later, it was down 70 or 80%, but the impact to the whole portfolio was like less than 1%, because it was a really small position.
yeah,
um, so yeah, it was a mistake, but it was a small mistake in the scheme of
yeah.
things.
Nice. Can you? I want to transition into YouTube here in a second, but
Yeah.
can you just speak to like when you make an initial kind of dipping your toe in the water investment, and then get to um, I don't know if deeper work's quite the term, but like sinking your teeth right into it and trying to get a really deep understanding. Can you just speak to us about what that sort of looks like? Because I saw a small taste of it when we traveled to Omaha. To be perfectly honest, I think I flew into Sydney. Um, we all had a bit of a break in our hotel rooms, I think,
Mm.
before we went out and had dinner and some drinks and stuff. And I think you came out of your room having just like crunched some serious numbers on that one company that you bought that we'll talk about later during your little
Yeah.
nap time that everyone else is having. It seems like you get rather obsessed, I guess is probably the word for it,
Yeah,
with these
it
companies.
is
How's
kind
that
of,
look?
yeah, it is kind of, obsessed is the right word, because I do that with everything that I do, and people in my personal life will attest to this, that I just can get really obsessed with something as long as it's the sole focus that I'm kind of focused on. And yeah, well, in that case, you're right. So well, the company's Netflix. We'll talk about it later, but um, yeah, I'd already invested a little bit into the company. But what was happening while we were away was, I think they had their earnings for that quarter, and the stock had another significant tumble. And yeah, I was just the process really is just going extremely deep into all the publicly available information. So in that circumstance, I'm pretty sure I was going through. while I was away, I was just going through each of the quarterly and annual reports from when the company was founded, and I like going through chronologically. So I usually I'll read the more recent couple of annual reports first, just to get an understanding of the business today. But then I'll go back chronologically, and it's kind of like I'm like speed running the growth of the company to kind of see what strategies worked, what did they do that was a mistake, and then did they fix it quickly, what did the management team have to say, did they hide this, and just going through the life of the company. And you can do that with the presentations, the quarterly conference calls. There's so much publicly available information that you can just jump into, and that's what I was kind of doing. That's kind of like, yeah, that's usually what I will do after I've made. Sometimes I'll do it before, but yeah, usually around the time where I'm making that first kind of investment. It's kind of like to me, it just really helps me see the full picture of what the business is. I think if you only look at the last couple of annual reports, you just don't have a full picture of the company, and its life. And some things only happen in a business once every 8 years or once every 12 years. So if you're only looking at back a couple of years, you're not getting a full idea of uh, the problems that the business has been through and how management has handled it. Um, but yeah, I definitely get obsessed with things, and I just whatever it is, whether it's entertainment or so, like even I maybe some people will relate to this, but if I find a song that I really like, I'll have no issue putting it on, putting that song on repeat, and just while I'm working. So I'll just listen to one song for like 3 hours straight, which is kind of like psychotic. I'll do it with TV shows. There's a couple of series that I've watched. I've watched How I Met Your Mother, which is I think 7 seasons or something. Maybe it's more than that. I've watched it probably like 20 or 30 times, and there was a period where it was the only thing I watched, and I just watched it. Once I got to the last episode, I'd start the first episode again, and it was just every 2 weeks. I was just like watching the just over and over and over again. So yeah, I definitely do that with everything for sure.
Yeah, I was about to say, I feel as though you've understated how obsessed you can get with some of these things, but then you told the How I Met Your Mother story, so maybe that enforced some of the messages. Because I recall, that was in Sydney, like you're in your hotel room doing some of these numbers.
Yeah.
Then when we were traveling to the States, I think the Warner Brothers spinoff, I think it sort of just happened, maybe a month previous, and you were reading a lot of Warner Brothers
Yes.
Discovery materials. I just googled the book because I couldn't quite remember the name, but I think it's Seven Powers is the book you're reading at the
Yep.
time on competitive advantage. Again, reasonably aligned with that industry.
Yeah.
So yeah, it seems like you're going very deep just to try and get as good an understanding as you possibly can.
Yeah, and I think I think it can be hard to tell. I mean, of course, it's impossible to tell how much research or how deep someone's going, especially because my content now on YouTube is very much serving a much broader audience. Broad economic topics. I'm not really um, talking about individual companies at all. Really at all, let alone kind of going deep and sharing how deep I really am going on some of these companies. But yeah, I think it kind of helps the way that I structure my portfolio, where I'm really only looking at one idea at a time. Like I'm never juggling 10 different companies and should I sell these ones or buy these ones. It's just so much simpler than that. I have one company which I have my eye on, and I will just spend all my time on that. And if I read something that makes it seem like it's not going to be a good investment, I just move on to the next one. But always trying to just be as deep as possible on a few companies. Um, so yeah,
Yeah, I really like it. I want to transition into YouTube a little bit here because it's quite interesting. You mentioned there just then that you don't do a whole lot of individual stock analysis on the YouTube channel anymore. I think that's something you may be used to a little bit more of in the early days. But how do you sort of balance, the individual stock research for the portfolio against maybe slightly more macro topics sometimes on the YouTube channel, and just trying to be consistent all the time with putting out new, relatively fresh content? How's that
Yeah,
work for you?
well, I think so. When I started the channel, I very much was basically using YouTube as an outlet for some of the research, some of the stuff that I was doing. So there was this huge amount of overlap between the two, and there still is. I mean, they're both finance, so there is still overlap. But yeah, what I talk about on the channel now is kind of, yeah, it's like its own allocated time in my week, separate from the time allocated to my portfolio. And part of that is because I there's other things that I find interesting in the finance world other than just looking at individual companies. I mean,
Yeah.
I think how you do on YouTube, a lot of it comes down to how passionately you think, how passionate you are about a topic, whether it's you just do deeper research, or you come across more lively in the videos, or you do more editing, whatever it is. I think the level of passion that you put into uh, the content is really important. And those are topics also that I'm really interested in. Uh, but it's also kind of a balancing of what content I want to make and the content that will do well and serve a broader audience. And it just kind of is the nature of YouTube that if you want to access a larger audience, you need to have content that is desired by a larger audience. And uh, that's why if you look at the best performing YouTube videos in finance, that it's like, how does the stock market work? Because that's where the broadest audience is. The broadest audience is people who are not interested in finance really, or they're just wanting to understand the basics. So you've kind of got to sit along that spectrum. And I think when you're getting started, it helps to niche down and be specific because you can provide a lot of deep value to a very core audience. And then over time, it's really just this process of, or at least for me, it's been this process of serving a larger audience to kind of grow and scale in that way. So that's how I kind of think about it. But yeah, I mean, in terms of, I mean, like, so recent content has been, talking about Ray Dalio or Michael Burry's, economic predictions. They have no impact on how I invest. I don't consider them at all. It's just really interesting to understand how the economic machine works. And I think to a broader audience, people want to know, how do these things work? How does interest rates, why are they raising interest rates? Like, how does that even help with inflation? So I think people want to know want answers to those questions. And it's not to then make investment decisions, but people want to know. Those are the questions that people want to know. So, but yeah, in terms of my work week, it's very much kind of segmented now. But whereas before it might have been, I do a bunch of research on a stock and I'm like, oh, I can get a video out of this. And now it's,
Yeah.
I have the day that I'm working on a video and I have a day where I'm doing something else. Um, so yeah, that's how I kind of think about it. But it is interesting. The whole YouTube finance space, it's certainly evolved a lot since we started. There was hardly anyone making content, and you could really slap up any video and do well. Uh, and now it's a lot more competitive, which is, it's more challenging, but it's also exciting, and it kind of challenges you to come up with unique content ideas. And so yeah, YouTube has been very interesting ride.
Yeah. For those maybe less familiar with your journey on YouTube, can you talk us through what that's been like? Kind of starting from zero, like everyone does, and kind of growing it and growing a business around it to where it is now. And
Yeah.
I mean, I think you just relatively recently ticked over 100,000 subscribers, which is a fairly major milestone on YouTube as well.
Yeah, that was a fun milestone. I think that's kind of the big goal. I think uh almost anyone who starts a YouTube channel really has. Like, obviously you have smaller goals along the way when you're smaller because it's too far away. But I remember when I started and I thought 100,000, that would be kind of crazy. And I might
Yeah.
not get there, we'll see, but that's a big milestone I can see out into the distance. That would be kind of insane. But yeah, I think certainly for some reason when I started, I just felt as though if I made content consistently, it didn't matter how little views they got, it would snowball. I just had a lot of faith in that. And part of that was because I watched Brandon, who runs the New Money channel, and at the time it was Aussie Wealth Creation, and I watched him from a couple hundred subscribers, I think, up until 1,000 or something across a year. I watched him, and I noticed that there really wasn't much finance content, and Brandon wasn't getting a huge amount of views, just a very small amount of views anyway. But I saw it snowball, and I just had, for some reason, I was just confident that if I just kept doing it, it would work. Which was kind of I don't know. I don't know if that was rational, but I'm just glad I did it, because I know most people kind of, you start something and you're not going to see results for a long time. And it can be really difficult to stick it out when there's no results. And for some reason, I mean, it's probably just because I really enjoy doing it, but it was, I had no issue putting out a lot of content. I was doing like 3 videos a week for a very long time. But yeah, I mean, once I got to 1,000 subscribers, which I think was just over a year in, then it was kind of, then I had evidence of, okay, this is working. I just need to keep doing it and keep moving. Um, and the strategies to grow were different back then to what they are today. So it was a little bit. I'm not sure if how it would be growing today in the environment, because there just are so many finance channels. But back then, I would just, one of the best ways to grow was simply to just try and do as many collaborations with other channels. It really didn't matter who it was. There was almost no crossover between finance channel audiences for some reason. It was like, this person had 1,000 subscribers and their little audience, and then this person had 1,000 subscribers and their little audience, and there was just no crossover. So as soon as you do a collaboration, you'd get almost all of their subscribers. It was like, it was the strangest thing ever. I remember I did maybe 10 or 15 of these collaborations, and just saw a huge amount of growth that way. And I'm not sure if you can really do that anymore. um, but yeah, that was a lot of the grindiness at the beginning. And then today, I mean, it's definitely become more difficult for me to stay consistent. I think it's hard to, explain, especially in a few sentences, how inconsistent or difficult it actually is to do something for like 5 years. um,
Yeah.
and it's, if you just look at where I am today and where I came from, yeah, it looks like it's just grown consistently, but it certainly hasn't been, a straight ride or easy. I've had long periods, like 6 or 7 months, where I felt as though I couldn't grow the channel, and I had to really kind of dig deep into making the content better and looking what was wrong with it, and fixing my schedule. And yeah, it's been I'm sure it's something I like, meeting and talking with other people who do content creation, because I think it's something that's very difficult to understand what the process is like if you haven't gone through it. I think it looks maybe really easy, or I'm not sure what it looks like to the outside, but it is a. I'm not saying it's particularly overly difficult compared to other jobs, but it is something. It has a lot of unique challenges that I'm sure is difficult to understand.
Yeah, for sure. I mean, when I first got started, I mean, when did you get started? Would have been 2017
I think
around.
I think it was 2018. I think it was the beginning of
Hmm.
2018. Um,
Yeah,
yeah,
yeah. I mean, I think I was late 2018, and Brandon must have been about a year before that. I would have thought roughly.
yeah,
But you're quite right. Like when I first started making YouTube videos, I would see, Jeremy Financial Education, I think, was probably the biggest channel at that point. He was growing really fast. Started watching a few of his videos, and certainly saw you and Brandon growing as well. And yeah, you sort of watch a 10-minute YouTube video, and you're like, all you got to do is talk to a camera for 10 minutes and it's done. And then you sort of you sort of fast forward
well,
to now, and it's
yeah,
like, potentially hours of research,
yeah,
a lot of forgetting how to string a sentence together when you film the video, and then
yeah.
obviously lots of editing and things too. So
Well, the truth is that when we all, maybe this is, I'm not sure about your experience, but for me, obviously there was thought that went into the videos, but in hindsight, the effort that went into a video was so small for the fact that it led to where we are today. It's just kind of crazy. I mean, all of my videos are still on my channel. You can go, and anyone can go and look, and they're horrifically bad. So it is kind of crazy that you can just have this yeah, you get growth out of it. But yeah, the amount of time I put into a video is probably 4 to 5 times like the number of hours I'm putting in now compared to before. So significantly more. Uh, and it is definitely more challenging in part because you're bigger, so you're trying to make content that is loved by a larger audience. But it's also definitely more competitive now than it was, um, for sure. So the fact that we got like 3, 4, 5 years of basically practice on
Yeah.
making content before anyone really realized how lucrative the sector is on YouTube is
Mm.
is what I don't know, you call it luck or whatever it is, right? But that's yeah, that definitely helped. If I made the content that I made at the start today, I'm not actually sure if even if I was consistent with it, I don't know if it would have the same result. I really don't know. Maybe I'm wrong. Maybe it would, but uh, yeah, I don't know. Maybe that's just me looking back in hindsight, but it certainly feels that way.
Yeah, it does. I think everyone's really just turned up the quality standards several notches. Like when you look
I
at
think so.
the type of production quality someone like Brandon's pumping out now, it's next level. I mean,
Yeah,
I've told the story a couple of times, I think, but I I should probably go back and find it, but there is a video in the early days of my channel somewhere where, again, probably overly influenced by Jeremy, I went and got a whiteboard and stuck on my wall, and I would write on the whiteboard in some videos. And in one of those videos, the whiteboard literally fell off the wall, and I just kept it in. I just kind of kept the video going. Like, these days that there's just no way you'd keep that type of stuff in the video. Everyone's turned it up a notch.
yeah. Well, yeah. I mean, look, YouTube is going to head the same way that television did, and it's just going to get the production quality and the competitiveness of the quality of the content is just going to go up and up and up because there is still this huge amount of revenue that is coming over. Like, yes, YouTube has a lot of advertising revenue, about 30 billion, and we get to take about 17 billion of that as creators. But that is a drop in the bucket of what's to come from cable and broadcast television as those mediums decline because the younger generation are watching YouTube and the older generation is still watching television. And that's really the split. I mean, there's obviously crossover, there's a bit of both, but that's the split still. And you're going to see the younger generation grow up, I would imagine, wanting to continue to consume YouTube. And the revenue pool is just going to get bigger. And the number of players in the space is also going to get a lot bigger. How long's YouTube kind of been? I mean, in terms of monetization, YouTube has really only been, it's like about a decade, I think a little bit less than a decade. I mean, in the scheme of the growth of different industries like cable, which has been growing since the 80s, so like 4 decades, it's a, it's been a very, very short amount of time. And yeah, we're just seeing the beginning of it. It's very, we're really lucky in a way because we could start with such simple setups and maybe simple setups will still work over time. I don't know. Maybe there is a particular appeal to that, but I would imagine over time it's going to be more teams like Brandon's team, for example, that are making much more high quality and consistent quality content. I would not be surprised if we look back in a decade and think, I mean, if you look back in a decade to YouTube content, like look how like the content was just, it was random, it was low quality, there was no structure to it. Today, there's like formulas for how you make a video, how you hook an audience, where to place the ads. There's a lot of structure. And in another decade, we're going to look back at this and go, oh, that was the era on YouTube where, you know, people tried to, make some good quality content, but it was all a lot of individuals still. And I don't know if that'll be the case. Maybe I'm wrong, but I wouldn't be surprised if we're looking at, you know, basically studio productions in a decade on YouTube in a big way.
Yeah, I tend to agree, and I mean, there's people already at that level. Like you say, it's
Of
getting
course, yes.
super competitive. I think it's certainly not going to go the other direction. So
No.
yes, you would think it's gonna keep pushing. Yeah, like you say, to like closer and closer to sort of TV level standards, I guess.
Yeah.
What's it been like trying to wrap sort of a business around the YouTube channel? Because for people unfamiliar, you've been more or less doing this full time for a few years at this point, right?
Yeah. So I've been full time since 2019. So 19, 20, 21, 22. Yeah, it's like 4 or 5 years, for 4 years. Um, and yeah, fortunately in the finance part of YouTube, advertisers are willing to pay a lot. So you don't need to produce as big of an audience to survive off it. Um, but at the same time, finance is a smaller market. There's less desire for finance content than there is for comedy content, right? So comedy will have, far less, advertisers are paying far less for ad placements, but there's a much bigger, they're swimming in a much bigger ocean. So if they're good, they can capture a much larger audience. But there's a lot of ways that you can make, you know, other outside of advertising, make money on YouTube. And I've kind of experimented with a few of them. For a while I was kind of going down a route of using YouTube as basically a marketing funnel into an education platform. I've kind of shifted more back to focusing on the content because that's really where my passion really is. I still kind of do a little bit of that on the side, but mostly my attention is on the content. Um, and it is interesting. It's certainly challenging business to run because it is so volatile. And especially if you're relying on advertising and then sponsors who pay based on your recent video performance, and that's like kind of your main revenue sources, it can be extremely volatile. Um, so that can be really difficult to kind of grasp any level of consistency. And it's not something that most people have to deal with. I mean, most people kind of have if you're in a normal job, you kind of have a track that you're on for, getting to where you want to be, whether it's an executive of a company or whatever it is. But it's not like every day you get an update on whether you've moved forward or back.
Yeah, hey,
And
hey, your
that's,
pay went down 30% this week. Sorry about that.
yeah,
Yeah,
exactly. So it's it's very strange. It's something that, especially as I've gotten bigger, it's kind of gotten worse in a way where my emotion is very much tied to the performance of the channel, and that's not a good thing. And it's something that I've spent a lot of time trying to deal with, uh, because it's really bad because it is volatile. I mean, you have months which they're insanely good, uh, and then you have months which are, even if they're still a good month, if it's less than the month before, you just have this psychological thing where you think something's wrong, and it's having that much input on your results is really not good. it's
yeah,
it's not good, especially for someone who's really into numbers and obsessing over stuff like that. It's really bad. But that's just the nature of it, and there's benefits to being able to track your performance accurately as well. A lot of people are probably in a job and they've maybe been in the same role for a year and they really don't know where they stand. Have they made progress to getting to where they want to be, or are they just or have they actually declined and the management is never going to give them a raise or move them into a new position? So some people are, I'm not saying it's all negative, but it is just different. So yeah, it's interesting, but yeah, I don't know. I can't even remember what the start of the question was.
it was around sort of wrapping a business around growing the YouTube channel. But one thing I was going to add on to what you just said is, do you think the volatility of your source of income essentially with the YouTube channel and the business, do you think the volatility there that you've got a stomach helps with the stock market volatility? I would think in a way it's sort of the stock market volatility sometimes pales in comparison to what you're doing with YouTube.
Yeah, I think I don't know. I think when it comes to the volatility in the stock market, because I know what I'm invested in, I know that it doesn't reflect where those investments are going. Whereas with YouTube, I don't know. I think I'm not as certain. Maybe I'm just not as confident in
Got it. Yeah.
in what I'm doing. I guess that when there is a bad month, I really do get. I don't know. My emotion is very much tied to it. I really do think I need to turn this around. The next month can't be worse than this, and it's just uh, so it is interesting that you mentioned that because I hadn't really thought of it from that perspective. But they're both really volatile. But yeah, I do feel like my emotion is tied to uh, the YouTube performance, but not to the stocks, which is interesting. Um, yeah, I don't know.
Yeah.
I think I think with YouTube, I'm just a little bit jaded because I have had long periods where it's been quite bad, at least from what I'm trying to achieve. Um, so yeah, that's kind of it.
Yeah, and it's strange because you're potentially doing absolutely nothing wrong. Like you're using
Yeah,
the same formula and same consistency and same thumbnail and title styles or whatever that worked well the previous month. It's just
I think
sometimes the
yeah.
algorithm's on your side and sometimes it's not.
Yeah, I think because I'm quite harsh on myself, and I can always find things when I'm not doing well on the channel. You're right; it could just be that there's less interest in finance that month, and that does happen. But I can also always find things that I should be doing better, whether it's keeping to my schedule, or not letting bad habits creep in. There's always things, and that's something that I've on a personal level have struggled with because I do go through these periods where it's very difficult for me to focus or um, to to just have any kind of consistency. Um, so yeah, just that's where a lot of my time has gone, especially over the last couple of years, has just been to managing my uh, uh, I guess my schedule and food and those kinds of things, and then sleep, and try and fix those kind of core things. Because I think when those are going well, then everything else kind of goes well, and that probably applies to most things people do. If you get kind of the fundamentals right, like if you can sleep, if you're getting on a good sleep schedule, you're exercising regularly, you're eating well, you've got good work schedule, then other things kind of tend to just fall into place.
Yeah, completely agree. Um, I'm just a little bit conscious of time here, Hamish. I really wanted to pick your brains on Netflix. I'm wondering if, or I guess streaming more generally, but I know you're deep in the weeds with Netflix. I'm wondering if we just jump straight to some audience questions from YouTube and Twitter because a lot of them are about streaming and Netflix. So
Yeah,
that's
for sure.
probably not a bad place to start just to see what's on people's minds. Um, where's a good place to start? This is an interesting one because I guess this gets to the heart of probably Netflix valuation, the whole free cash flow versus owner earnings kind of discussion. So this is on Twitter from Devon Toogood. What is Hamish's view on what proportion of Netflix capex is maintenance capex and what's growth capex? Do you want to maybe
Yeah.
firstly just give a bit of background on why that's important, particularly for Netflix, and then maybe give us some of your thoughts on
Yeah,
it?
so that's one of the major questions around Netflix as an investment is how much of their content spend is just to keep their existing sub base and how much of it is to drive growth. And the reason for that is because Netflix themselves so how their content works is they spend money on the content, and it creates a content asset essentially. And then on the income statement, that will be amortized, so it's kind of depreciated by the company, and they kind of depreciate a proportion, and that means that the operating income on the income statement is very different to kind of the operating cash flow, where the operating cash flow is kind of subtracting all of the content spend, whereas the operating income is just subtracting the used up content spend. So that's kind of the difference. And of course, as value investors, we care about cash flow. We care what we can pull out of the business at the end of the day. So a big consideration is how much of their content spend is just to keep their sub base as it is, and how much of it is they're actually just choosing to invest more to grow in some of these international markets. And there's a lot of ways that you can go about estimating this. There's a few different ones. One of the main ways that you can do it is simply by taking management's amortization figure as the maintenance capex. And there's a couple of good reasons why that may be a reasonable way to think about it. When it comes to physical assets, depreciation often is a terrible estimation of the value decline in those assets. But when we're talking about a company that is basically able to assess how much watch time every piece of content gets, there's pretty good reason to believe that uh, Netflix would have a pretty good grasp on which content is still driving value and which content is no longer, or let's say 95% of the value has been gone. Like it's gotten 95% of its watch hours, and now it just gets the occasional person who revisits it. So there's a good reason to believe that management has enough data to actually do that amortization calculation fairly accurately. But then there's other ways you can go about it uh, as well. You can try and do your own estimation, whether that's looking at where content spend is around the world and making a projection that, well, they don't have many subs in this region and they're spending a lot of content. So that content spend is likely mostly growth expenditure. So there's kind of different ways you can go about it, but that's how I'm thinking about it. And then I'm using kind of multiple methods and combining them, and there's no exact figure that I'm getting to, but it's I'm getting to kind of an approximate of where I feel that it's very likely that when I'm buying the stock, I'm going to do well. That's where it comes back to at the end of the day.
Nice. Could you also speak a little bit to how that amortization impacts the tax situation at Netflix? Because potentially there's some incentives, I guess, in place there that could change how you might think about that.
Yeah, so I mean, yeah, you could definitely make the argument, and I did in a previous video where you could make the argument that they could overestimate amortization in order to lower their tax. You could definitely make that argument. You could also make the argument that they would want to lower their amortization to produce higher operating income to satisfy the market. So you could, I think you can argue it both ways. Um, but combining what I know about the management team and the information they provide about how they amortize and just the nature of their business, I think yeah, look, using their amortization is a fairly reasonable way to approach it. Whether it's exact, I don't know. But yeah, it's certainly different to a business that's, if a business is spending a lot of money on machinery and vehicles and office equipment and stuff, those things have depreciation schedules that are basically just accounting paperwork that it's completely separate from the actual loss in value of those assets. And that's very different to Netflix, which is kind of, I can view it similar to if I had to value my content. I know on average where all the views are going to come. Most of the views are going to come in the first 24 hours. And then after that, I can say after a week, on average, 90% of the views have come in for the average video. And that's what you actually see in Netflix's report. They say on average, about after 4 years, 90% of the content has been amortized, that the 90% of the value is gone. So my presumption, and I'm only presuming, I don't know, but my presumption is that they're using kind of the process that I just explained for my YouTube channel. They're doing a similar thing to their content and valuing it based on how much watch time there is left. And they would have an enormous amount of data on that. So there's good reason to think that they could be fairly accurate on it, except for, of course, the occasional show coming back in a way that they didn't expect, which is only going to add, a positive effect to the valuation.
Got it. This is a follow up from me, but when you talk about maintenance versus growth, you mentioned primarily subscriber growth. But do you think about sort of price growth in that equation as well? Like, the I think North America, for example, subscribers are basically flat, largely because if you account for password sharing, they've got every American basically
Yeah,
subscribed to
yeah.
Netflix already.
If you take
Yeah,
the password sharing, they're in 100 households out of 110 pay TV households. So
yeah,
they're in every pay TV household, and you could argue that more than pay TV would be there. But yeah, you're right, and I think this speaks to one of the unique advantages that Netflix has, which is every time they increase the subscription, they're increasing the value for everybody. So yeah, you pay an extra dollar per month, like they did the price increase the beginning of last year. Uh, but you're also seeing, a plus $1 billion or more uh, in content spend. So you're essentially, and that content spend is available to everyone. So they're in a very unique situation where they do, price increases don't just hurt the customer. That yeah, sure, you pay a bit more, but you also get more, and therefore you might be willing to pay a bit more. So then you get more, and it's kind of this flywheel in a way. So yeah, you're right. Definitely more. The price increases are something to kind of consider, especially in the US, where yeah, you're right. There's not going to be much growth in that market really at all in terms of subscribers.
yeah, nice. We had a few questions around, I guess, competition. So if we maybe broaden out on streaming more generally, I've heard you make a few comments in the past about um, how to a large extent a lot of the players in streaming, their business models are kind of unsustainable at the moment. They just don't have scale to produce positive cash flows essentially.
Yeah.
Do you mind just sharing some general thoughts on that?
Yeah, I
Because
think the
it seems like everyone's getting into streaming, and
yes.
I doubt everyone's going to make it out the other side with a profitable business. I guess is sort of the point here.
Yeah, and that it is a bit of a complex kind of picture, but really to simplify it, the way I think about the competitive advantages is uh, the first question is, do they have a superior product? Like as it is today, regardless of new competition or what it looks like in the future, today, do they have the best streaming service by a large margin? And then the next question is there any characteristics that will ensure that they remain in that position over the long term? So those two questions are different. It's not enough for a business to have the superior product. It has to be superior, but then it has some kind of intrinsic durable moat around it that protects those characteristics over time. Because if you have something great and you have no moat, competition will just copy it. So there's kind of two like steps there. Um, in terms of superior product, I don't think you can really, besides anecdotal stuff that I've seen a lot of people talk about, you can't really deny that Netflix has the most superior streaming service, whether it's engagement, their pricing power, their lowest churn rate. I won't go into the details of those, but they're leading in every category when it comes to the quality of the platform, the UI as well, everything. There's really no denying it. So then really the question do they have durable characteristics? Do they have some kind of moat? And I think they kind of have two moats. In a way, there's kind of two aspects, and the second one kind of speaks to your question. The first is the scale economics. So it's a business where the larger you are, the better the economics are. And so in Netflix's case, yeah, they're spending a lot on content, but the content spend per subscriber has declined since 2018, and at the same time, revenue per subscriber has gone up. So those are two, unit economic measures, I guess, through which additional spending and additional scale, they've become far more efficient. And then you can, you could arguably say that they share the majority of that economic benefit with customers in the form of more content and therefore better quality content. Um, then the other competitive advantage is really what's called counter positioning, and there's a really good explanation of this in Seven Powers, which is the book that I was reading when I was when we we're in the US. And essentially, the kind of the one word that they use for counter positioning, or the one line for counter positioning, is a newcomer adopts a superior business model which legacy businesses don't copy due to anticipated damage to their existing businesses. So it's essentially a process where uh, a new business has a superior business model, but it also can't be easily copied because they'd be cannibalizing their existing revenue streams. And that's kind of the situation that legacy media businesses face at the moment. Is they've for a very long time been distributing through theatrical release, cable licensing, and now they're adding this streaming element. uh, and the more that they put content on streaming services, the worse, the more that they cannibalize their dying revenue streams. And on top of that, we didn't really know this until the last couple of years, but it also now looks like streaming is a lot less profitable than cable. And you could have maybe made this prediction. I kind of thought this would be the case, but we didn't really know for sure. But it looks very much now like cable is going to be a lot less. Streaming is a lot less profitable than cable. And a big reason for that is just cable is just a terrible way of consuming content. I mean, you pay a huge amount of a monthly, and you get a huge amount of channels bundled together, most of them that you don't watch. So these media companies are getting paid out, even though people aren't consuming, their actual shows. There was a massive disconnect between the watch hours or the engagement of what they're producing and how much money they were making from that content. And that's kind of one of the efficiency benefits, I guess, that streaming brings, is people can selectively choose where they want to spend their money. So uh, those are a couple of the difficult characteristics. I think the other thing to kind of consider is that streaming seems to only work at scale, as you kind of mentioned, which is another very difficult challenge for these media companies that have to balance. Do they really want to kind of sacrifice their legacy businesses and pursue this streaming business? or do they kind of pull back from streaming and increase their profits in the short term? And that's really what we've seen play out over the last year. I mean, you've seen Warner Brothers, Disney, they've all started to cut content spend. They went through a couple of years where they loaded up on content spend, were very unprofitable, and they scaled a little bit. But as soon as they've started to pull content spend back and increase prices, which is not a great thing to do, you shouldn't be raising prices and pulling the quality of the content at the same time. The subscriber growth in these businesses has halted basically. So they're in a very, very difficult position where cable is going away. Like that's not a question of if, it's a question of when. Cable is gone. So they're clinging to these old revenue streams, and I just the position that they're in, it's just very difficult for them to commit to streaming. We'll see it to some extent in some players, but a lot of them will not commit to streaming, and they'll end up basically just being the media producer instead of distributor. So that they won't go into streaming, or they will a little bit. They'll dabble, but it'll be unprofitable, and then cable will die, and then they'll just be a content. They'll just be selling content to other distributors, like Sony does at the moment. So that's kind of a piece of what it looks like, but it is very complex, and there's there's a lot of components. There's hours. I could talk for like 10 hours, and I'd probably still be going on this stuff. So
Fair enough. Well, it shows that you've done the work, if anything. It's really weird. Like, usually when you talk about businesses getting to scale to be profitable, you're not talking about them having near 100% household penetration in a super developed country like the US. Like the scale these
yeah,
competitors have to get to is kind of next level, right?
it is, and that's the thing is Netflix is in this really unique position now because they've made the investments that they can invest more than they need to into content, into international growth, and do it profitably. Whereas all the other media companies have to, and a lot of them are loaded up on debt from a lot of acquisitions or mergers. So they're facing tough questions about where's the best place to invest their money in terms of content, and where do they distribute it. And yeah, I think unfortunately for consumers, the last couple of years has kind of been the golden age of media, because not only was Netflix, a new player. I say new, but they've come in and they're spending a lot on content. But you also had Warner Brothers and Disney and Paramount overspending on content. So it's kind of the glory couple of years where investors, whether it's bond investors or shareholders, were basically subsidizing an abnormally high amount of content, and that's gone. That's going to go. So there's going to be far less content coming out, not from Netflix. Netflix will continue on their steady amount of content that they've been producing, but you'll see media companies, legacy ones, pull back at the same time as raising prices. And I have no idea how the chips fall. I don't know if Disney, where they lay in the end. I really don't know. But all I'm seeing is some very difficult operating environment for one group of businesses, and Netflix is way over here while everyone else is over here. And especially if we go into a recession where it is going to get really tough, higher interest rates means more interest on these loans for these companies. That gap is only going to grow between the two businesses. I feel like it's almost like we saw the last couple of years legacy media catch up to Netflix, and that because they were able to overspend on content. So I think we've seen how the closest that legacy media will get to Netflix. I honestly think we've seen the closest, and we will see the gap increase again as it was for the better part of a decade that Netflix has been operating.
Yeah, it's super interesting dynamic. One last question on Netflix, then we might wrap this thing up. This from Digby. You'll probably remember Digby from the Berkshire Backyard Barbecue, actually.
Yeah.
So Digby's question, probably timely given some of the management changes, I guess. A bit of a question monger inversion style here. So, what should Netflix management do to ensure a bad outcome for shareholders?
Um, yeah, I think this is going to sound backwards, but I think if they start to care about the bottom line and pull back on content spend, I think that's a disaster for them because, like Costco, and sure, they're not the same at all, but, Costco has never really pulled back on the idea that they will put as much of, every dollar in economic benefit back into lower prices. That's been their model. And that's why they have built this brand and built so much scale. And I think Netflix needs to do the same thing in a different way, which is, they're not using scale and lowering prices, but they're using scale to have better content and have a broader content array. So I think the worst thing they could do is give into investor pressures to, increase their free cash flow this year, or to increase that is completely irrelevant, really, at the end of the day. Because if they're overspending on content at any and more than they need to sustain their sub base, at any time they can just turn it off. And then they'll be this hugely profitable business. So there's really no reason for them to do that, especially where in the position they're in. I think you'll see a lot of legacy companies do that. I mean, Disney just announced a dividend, which is the most strange thing to. I know they paid a dividend for many decades, but it is such a this is a weird way to put it, but it's an expense that Disney doesn't need right now. Like I kind of view a business as separate from the investor in a way. Like, what does the business need? Not what does the investor want? What does the business need to be, much bigger in the future? And Disney's going to be handicapped by the fact that they have to satisfy investors who want cash flow. Paramount will be the same, and Warner Brothers will be the same. And that's not to say they won't be good investments as pure value plays or something like that. They might, but in terms of who's going to be the dominant player in this space, you're paying a dividend is not gonna help you. So it's definitely I don't know, maybe that seems backwards to a lot of people, but I don't really care about the cash flows in the next couple of years. I'm looking so much further out than that. And if the media companies continue how they've been operating and Netflix continues how they've been operating, that gap is just going to get bigger and bigger. And the numbers almost don't even really matter in the end, because if they continue to widen that gap, the return will be so absurdly high that it won't matter. That's the way I kind of think about it.
Yeah, it's a bit of a weird situation with the Disney dividend thing. It's like it sort of seems like grandma who's had Disney in her portfolio for 40 years wants her quarterly dividend checks back, I guess. But
Yeah, well, and then that's we probably won't have time too much to speak about it, but that's another element that goes into the counter positioning is, uh, what do investors expect? And almost every time you have a counter positioning example in history, uh, there's been almost always the media, the not media, the legacy companies try to transition, and then they're almost always stopped by investors. Almost always. I mean, even if you look at Netflix's last against Blockbuster, they had a similar thing against Blockbuster, and Carl Icahn stepped in and basically stopped Blockbuster from pursuing streaming, which they were making moves. And they actually, if you look at Netflix's early annual reports, they mentioned that Blockbuster was starting to make an impact on their ability to grow in streaming.
hmm.
So, but it's just kind of the nature of how it works is investors come to expect cash flow, they come to expect dividends, and they just can't get around the idea of pursuing this new business, even if the old business is dead anyway. It's just something that people can't wrap their head around. I mean, Blockbuster was going to die. The video rental was going to die. It wasn't even a question of if, it was a question of when. But still, you had investors, large activist investors, who just wanted to squeeze it for money rather than see it transition. And I think it's very likely we'll see it happen again.
Yeah, very good point. Hamish, I've got one last question for this episode, completely unrelated to streaming or anything we've discussed so far. This is from Musa on YouTube. I guess this question's for me, but I'll let you answer it. Who would win in a fight between you, Hamish, and Brandon, and why is the answer Hamish?
I definitely would not win that. I have zero ability to fight. Oh yeah, who would win? I'd back Tom in.
I think you'd have the speed advantage, maybe.
Speed? I don't
Like if
know.
you wanted to use just an escape tactic as opposed to winning.
I could just run away. I don't know if that
Yeah.
counts as winning though.
Yeah, I don't know. Maybe you've been like training jujitsu, real undercover or something. Can you take us
Yeah,
both out? I don't know.
secretly a black belt in karate.
Yeah, there you go. Good question, unclear answer, but thank you nonetheless, Musa. Hamish, this has been a lot of fun. It's always great to talk to you. For those that somehow are following me but aren't following you already, where can people go to see or hear more from you?
Hamish Hodder on YouTube, or I should say for everyone, Hamish Hodder. ER at the end. It's not
Yes.
Hamish Hodder, although that's the Australian pronunciation. But yeah, YouTube's the main thing that I'm doing at the moment. So yeah, or Young Investors podcast if you want to check it out. Me and Brandon's podcast.
And your buddy, I think there's a third mystery guy we're still yet to
There
see.
is there is a third unknown participant. Yeah.
He'll appear someday. Thanks very much, Hamish. I'll link all that down in the description and show notes for people. But appreciate your time, and we'll do this again soon.
Yeah, thanks for having me on.
Thanks for watching another episode of the Investing with Tom podcast. If you enjoyed this episode, be sure to subscribe so that you can see future content as soon as it goes live.